Is shifting in the world of big money. The giant, secretive hedge funds, the billion-dollar players who move markets, are suddenly making a massive, unusual bet. They're not just buying stocks or bonds, they're buying things you can touch, things that power our world. They're buying natural gas pipelines in Texas, storing electricity in massive batteries in Germany, and cornering chunks of the physical power grid across Europe. The Financial Times reports that funds like Balyasny, Jain Global, and the behemoth Citadel are piling into commodities like never before. The big question is, why? Why now, when the wild market swings of 2022 have calmed down? And more importantly, what does their rush into the real world of oil, gas, and copper mean for you, for your savings, for your retirement? Over the next 9 minutes, we're going to break down this monumental shift. We'll look at what the hedge funds see that others don't, and then we'll dive into new research from ANZ Bank that suggests the commodities themselves are sending a powerful signal about the health of our global economy. This isn't just a story for Wall Street, it's a crucial signal for every investor. So let's start with the why. Why are these massive funds, accustomed to trading digital contracts in milliseconds, suddenly interested in owning physical assets? It boils down to one thing: information. Michael Alfaro, a hedge fund CIO, called it an information gold rush. Think about it. If you're just trading oil futures on a screen, you see the price. But if you own the storage tanks, if you have the rights to a pipeline, you see the flow. You know who's buying, who's selling, and how much, long before any official data is released. You get a real-time pulse of the economy. Citadel, for instance, made a fortune trading natural gas during the price chaos after the invasion of Ukraine. They saw the opportunity. This year, they've been on a buying spree, acquiring a gas field for over $1 billion and even buying a German energy trader that's developing its own battery project. Jain Global bought a natural gas services firm. Cube, a fund that relies on complex computer models, is now trading physical power in Europe. They're hiring experts directly from utility companies. They are getting their hands dirty because the reward is too big to ignore. They understand that while 2022 was a year of historic volatility and profits, the future is about capturing smaller, smarter advantages. It's about anticipating shifts in power demand using advanced weather data. It's about storing electricity in a battery when it's cheap and selling it back to the grid a few hours later when demand peaks. For these funds, adding physical commodities is a way to diversify, to create a new stream of returns that isn't tied to the whims of the stock market. Sure, there are risks. A fund named Amaranth famously collapsed years ago betting big on natural gas. But for today's giants, the potential rewards seem to outweigh those dangers. Their massive move is a flashing signal. Commodities are becoming a core source of returns in these uncertain times. But the story isn't just about what the hedge funds are doing. It's also about what the commodities themselves are telling us. And right now, one metal is speaking louder than all the others: copper. Analysts at ANZ Bank recently released a research note titled Dr. Copper's Positive Diagnosis. They call it Dr. Copper because this metal is used in almost every sector of the economy, from housing and construction to electronics and cars. Its price is a fantastic barometer for global economic health. If demand for copper is rising, it means people are building, manufacturing, and buying. And right now, Dr. Copper's diagnosis is surprisingly strong. Despite worries about a global slowdown, copper prices are up over 7% so far this year. All other major base metals are up too, except for zinc. This signals a recovery is underway, especially in China. The data backs this up. China's industrial production is growing at over 6%, with sectors like auto manufacturing up nearly 18%. What's driving this demand? Two massive global shifts. First, the green energy transition. An electric vehicle uses up to 7 times more copper than a traditional car, and building out the new power grids needed for renewables requires staggering amounts of it. Grid investment is projected to grow by 18%.
Second, the AI revolution. All those new data centres powering artificial intelligence are incredibly energy intensive and require vast amounts of copper wiring and components. Inventories of copper are falling while imports are at their highest level since 2020. The outlook is positive. ANZ predicts that Chinese stimulus, a strong US economy, and the unstoppable trends of green energy and AI will continue to push demand for copper, other metals, and energy commodities higher. For investors, this is the fundamental story that underpins the hedge fund's big bet. So, the big money is moving in, and the economic doctor, copper, is giving a positive checkup. What does this mean for most people? For your family's budget or your retirement plan? In a world of inflation, geopolitical conflict, and economic uncertainty, commodities serve two crucial roles. First, they are a hedge against inflation. It's simple. When the cost of living goes up, the price of the raw materials used to make everything, from your food to your fuel, also goes up. Owning commodities can help your portfolio keep pace.
Second, they offer diversification. You've heard the saying, don't put all your eggs in one basket. That's all diversification is. Historically, when stock and bond markets go down, commodities like oil and gold often hold their value or even go up. They zig when other assets zag. They offer a layer of protection. This isn't just a tool for the pros anymore. Thanks to modern financial products, the average person can benefit from these trends with just a few clicks. It's a way to potentially earn steady returns that can beat a simple savings account, especially in times of high inflation. So, how can an average investor get involved? You don't need to buy a barrel of oil or a bar of gold and store it in your garage. The easiest way is through exchange-traded funds, or ETFs. These are funds that you can buy and sell just like a stock through any normal brokerage app like Robinhood or Vanguard. They are low cost and do all the work for you. For example, if you believe in the Dr. Copper story, there are ETFs like CPER that track the price of copper. If you want exposure to oil, there's USO. For gold, a classic safe haven asset, there's GLD. And if you want a broad basket of many different commodities all in one, you can look at something like DBC. The key is to start small. Most financial advisors suggest allocating maybe 5 to 10% of your portfolio to commodities as a diversifier. This is not a get-rich-quick scheme. Commodities can be volatile, so it's essential to do your research and understand the risks. But they are no longer an obscure, inaccessible asset class reserved for Wall Street's elite. They are a modern tool available to everyone. The rush by hedge funds into physical commodities is more than just a headline. It's a fundamental shift, a loud vote of confidence in the future of real assets. It tells us that in a complex world, there is immense value in the things that build our cities, power our homes, and drive our transition to a new energy future. The positive diagnosis from Dr. Copper and the broader strength in the sector suggest this isn't a fleeting trend, but a long-term opportunity. For you, the everyday investor, this is a moment to pay attention. It's a chance to consider a strategy the smartest money in the world is using to protect itself and find new growth. This isn't just about chasing returns, it's about building a more resilient, diversified portfolio for whatever comes next. The titans of finance are making their move. The question is, are you ready to consider yours?